My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is Foreign exchange market. The foreign exchange market, forex market, is where people buy and sell different currencies of the world. Just like we exchange rupees to buy dollars when going to the USA, businesses and investors also exchange currencies for international trade or investment. Example. Imagine Tata Motors wants to import car parts from Japan. They must pay in Japanese yen, not Indian rupees. So, Tata will go to the forex market to exchange rupees for yen. The exchange rate tells how much one currency is worth in another. For example, if $1 is equal to 83 rupees, it means you need 83 rupee to get $1. Key point to remember. Think of forex market like a giant money exchange shop for the world, where prices of currencies change every second. It helps companies, travelers, and investors deal in global business smoothly. Memory tip. Forex is equal to foreign plus exchange, exchanging money to connect with the world. Next important short question is 2 major participants. Major participants in the foreign exchange market. The foreign exchange, forex, market is where people buy and sell foreign currencies. It is the world's largest financial market. Here are the major participants. 1. Commercial banks. They handle currency exchanges for customers and trade currencies to earn profits. For example, SBI may exchange INR to USD for a traveler. 2. Central banks, like RBI in India, they control currency value and maintain stability. For example, RBI may sell USD to stop the rupee from falling. 3. Corporations, companies involved in international trade need forex. For example, Tata Motors may buy USD to pay for parts from the USA. 4. Foreign exchange brokers. They connect buyers and sellers in the forex market, like real estate agents in currency trading. 5. Retail traders and investors. Individuals trading through online platforms like JNTUH or Upstocks. Easy tip to remember C3RF. Commercial banks, central banks, corporations, retail traders, forex brokers. These players keep the forex market active and balanced. Next important short question is 3. Foreign exchange quotations. Foreign exchange quotations show the value of one country's currency in terms of another. It tells us how much of one currency you need to buy another. There are 2 main types. 1. Direct quote shows how much Indian rupees, INR, you need to buy 1 unit of foreign currency. Example, $1 is equal to 83 rupees. This is a direct quote in India. 2. Indirect quote shows how many units of foreign currency you get for 1 rupee. Example, 1 rupee is equal to 0.01 to USD. This is an indirect quote. Tip to remember. Direct is equal to desh ka paisa pehle, your country's currency comes first. Indirect is equal to videsh ka paisa pehle, foreign currency comes first. These quotes help in foreign trade, travel, and investments. Understanding them is useful if you are sending money abroad, importing goods, or going for higher studies overseas. Always check the latest rates, they keep changing. Next important short question is 4. Euro currency market, Euro credit market, Euro bond market. These markets are part of the international financial system where money flows across countries. Don't get confused by euro, it doesn't mean Europe only. 1. Euro currency market, a market where a currency is held outside its home country. Example, if US dollars, USD, are deposited in a London bank, it's part of the euro currency market. 2. Euro credit market provides short to medium-term loans in foreign currency, mainly to companies. Example, an Indian company borrows USD from a bank in Germany. This is euro credit. 3. Euro bond market, a market where companies or governments raise long-term funds by issuing bonds in a currency different from the country where it's issued. Example, an Indian company issues a bond in USD but sells it in Japan. This is a euro bond. Tip to remember. Euro is equal to outside the home country. Currency is equal to deposit, credit is equal to loan, bond is equal to long-term money. Next important short question is 5. International stock market. The international stock market is where people from different countries buy and sell shares of companies listed in foreign countries. Just like in India we have NSE and BSE, other countries have their own stock markets like New York Stock Exchange, USA, London Stock Exchange, UK, Tokyo Stock Exchange, Japan. Companies list their shares here to raise money from global investors. Investors can earn profits if share prices go up or receive dividends. Example. Imagine an Indian investor buys shares of Apple, a US company, from the New York Stock Exchange. If Apple performs well, the Indian investor earns a profit even though the company is not in India. Why it matters? Helps companies get more funds globally. Gives investors more options to invest and earn. Spreads financial risk. Easy to remember. Buy global, earn global. It's like shopping online, not just from India, but from the whole world. Next unit 3. Long questions. First important long question is function and structure of the forex markets. What is the forex market? Forex, foreign exchange, market is where people buy and sell foreign currencies. It is the largest financial market in the world, running 24 hours a day, 5 days a week. For example, if you travel from India to the USA, you exchange Indian rupees, INR, to US dollars, USD. This currency exchange happens in the forex market. Functions of the forex market. 1. Currency conversion. Helps people, companies, and governments convert one currency into another. Example, Infosys earns in USD from US clients and converts it to INR in India. 2. Hedging, risk protection. Protects against losses due to currency value changes. Example, an exporter fixes the exchange rate in advance to avoid future losses if the dollar value drops. 3. Speculation, profit making. Traders buy and sell currencies to earn profit from price changes. Example, buying USD at 82 rupees and selling it later at 84 rupee makes a 2 rupee profit. 4. Maintaining liquidity. Ensures people can buy or sell currencies easily at any time. Structure of the forex market. 1. Retail market. Small players like tourists and small businesses use this. Example, exchanging INR to USD at a money exchange counter. 2. Interbank market. Large banks trade with each other in huge amounts. 3. Central banks and governments. They control currency value and supply, like RBI in India. 4. Forex brokers. Act as a middleman between buyers and sellers of currencies. 5. Electronic trading platforms. Most forex trading happens online using apps and platforms. Easy tip to remember. 4 big F's. Forex helps with foreign money, fixes rates, fights risk, and fuels trade. In simple words, the forex market is like a big currency bazaar where people and banks trade money of different countries. It supports global trade, travel, and investment by making sure currency exchange is smooth and fair. It connects India to the world, 1 rupee at a time. Next important long question is: 2 types of transactions and settlements dates. Currency exchange. What are forex transactions? A forex transaction is when two parties agree to exchange one currency for another. The settlement date is when the actual exchange of money happens. Think of it like ordering something online, transaction, and receiving it after a few days, settlement. Types of forex transactions. 1. Spot transaction, meaning buying selling currencies for immediate delivery. Settlement date, usually 2 business days after the deal. Example, on Monday, an Indian company buys USD from a bank. The actual money is exchanged on Wednesday. 2. Forward transaction, meaning agreement to exchange currencies at a future date and a fixed rate. Settlement date, chosen in advance, after 2+ days. Example, an Indian exporter expects payment in USD after 3 months. To avoid loss if the dollar weakens, they lock the rate today. 3. Future transaction, meaning like forwards, but traded on a regulated exchange with standard terms. Settlement date, fixed future dates set by the exchange. Example, a trader buys USD futures for delivery next month on the NSE. 4. Swap transaction, meaning combination of a spot and a forward transaction. Example, a company buys USD today and agrees to sell it back after 1 month. What is a settlement date? The settlement date is when both parties complete the transaction by delivering the actual currencies. Spot, usually after 2 working days. Forward future, on the agreed future date. Swap, as per agreed timeline for both parts. Easy tip to remember. Spot is now, forward is future, futures are traded, swaps are 2-in-1. In simple words, forex transactions are different ways of exchanging currencies, either immediately or later. Settlement dates tell you when the money actually moves. These tools help Indian companies and traders manage currency risks and plan better. Next important long question is: 3. Process of arbitrage. What is arbitrage? Arbitrage is the process of buying something at a lower price in one market and selling it at a higher price in another market to make a risk-free profit. In forex, foreign exchange, arbitrage means making profit by taking advantage of different exchange rates in different markets or locations. Types of arbitrage in forex. 1. Geographical arbitrage, buying a currency in one country where it's cheaper and selling it in another where it's costlier. Example, in India, $1 is equal to 83 rupees. In Dubai, $1 is equal to 84 rupees. You buy USD in India and sell in Dubai to earn 1 rupee profit per dollar. 2. Triangular arbitrage, involves 3 currencies and makes use of differences in exchange rates between them. Example, let's say $1 is equal to 83 rupees. $1 is equal to 90 cents. 1 rupee is equal to 0.011 euros. If you notice any imbalance in these rates, you can convert INR to USD, then to Euro, and back to INR to make a small profit. Process of arbitrage, step by step. 1. Identify price difference. Look for differences in exchange rates for the same currency in different markets. 2. Buy low. Purchase the currency in the cheaper market. 3. Sell high. Sell the same currency in the market where it's priced higher. 4. Profit. Earn the difference. This is your arbitrage profit. Easy tip to remember. Buy low here, sell high there, profit without risk. That's arbitrage flair. In simple words, arbitrage is like finding the same t-shirt at 300 rupees in one shop and 350 rupees in another. You buy from the cheaper one and sell at the higher price to make a profit with no risk. In Forex, it works the same way with currencies. It's smart, safe, and sharp. Next important long question is 4. Speculation in the forward market. What is speculation? Speculation means predicting future price changes and making a deal to earn profit. In the forward market, people guess how currency rates will move and enter into agreements today for future profit. They don't need to import or export anything, they only trade based on their predictions. What is the forward market? The forward market is where two parties agree to buy or sell a currency at a fixed rate on a future date. What is speculation in the forward market? It's when a person or company enters into a forward contract not for business needs, but to earn profit by guessing currency movements. Example. Let's say today, $1 is equal to 83 rupees, spot rate. Forward rate for 3 months is equal to 85 rupees. Now, a speculator believes that in 3 months, USD will be 86 rupees in the market. So, they buy USD forward at 85 rupees. After 3 months, if the market rate becomes 86 rupees, they sell USD in the market and earn 1 rupee profit per dollar. This is called speculative profit. Important points. No actual import-export involved. It's based on future currency rate predictions. Profit or loss depends on accuracy of prediction. Easy tip to remember. Guess the rate, lock the date. If you are right, profit is great. In simple words, speculation in the forward market is like betting on future currency prices. You lock a deal today, hoping the rate will change in your favor. If you are right, you earn profit. If wrong, you may face a loss. It's like predicting that gold prices will rise in 3 months, so you book at today's rate and sell later for profit. Note: speculation can bring good profits, but also involves risk, so it must be done wisely. Next important long question is 5. Currency futures and options markets. What are currency futures and options? These are financial contracts that help people buy or sell foreign currencies at a fixed price on a future date. They are mostly used to earn profit or protect from currency risks. Think of them like booking a movie ticket in advance. You fix the price and seat today for a future show. 1. Currency futures. A futures contract is a legal agreement to buy or sell a currency at a fixed rate on a specific future date. These are traded on organized exchanges like NSE or BSE in India. Example. You expect that the US dollar will become stronger. Today, $1 is equal to 83 rupees. You buy a USD futures contract for 84 rupees, 1 month delivery. If after 1 month USD is equal to 85 rupees, you sell and earn 1 rupee profit per dollar. Used for speculation and hedging, risk protection. 2. Currency options. A currency option gives you the right, but not the obligation, to buy or sell currency at a fixed rate before a certain date. You pay a small fee, called premium, to get this right. Example. You buy an option to buy $1 at 84 rupees. If USD becomes 86 rupees, you use your option and earn profit. If USD drops to 82 rupees, you don't use the option, you only lose the small premium. Used for risk control with flexibility. Easy tip to remember. Futures is equal to must do the deal. Options is equal to your choice to do the deal. In simple words, currency futures and options are tools that help traders and businesses manage currency risks and also earn from currency rate changes. Futures are like fixed agreements, while options give you a choice. One-line formula. Fix the rate, choose the date. Futures and options help you trade. Next important long question is 6. Exchange rates. Can $0.665 per diem, spot. Can $0.670 per diem, 3 months, interest rates, diem 7% PA. Can $9% PA calculate the arbitrage gain possible from the above data? Given data. Spot rate, 1 diem is equal to can $0.665. 3-month forward rate, 1 diem is equal to can $0.670. Interest rates. Germany, diem, is equal to 7% per annum, 1.75% for 3 months. Canada, can dollar, is equal to 9% per annum, 2.25% for 3 months. We will use covered interest arbitrage to check if there's a profit opportunity. Step-by-step arbitrage process. Let's assume we start with 1 million diem. You can pick any amount to calculate percent gain. Step 1. Convert diem to can dollar at spot rate. Spot rate, 1 diem is equal to 0.665 can dollar. Can dollar received is equal to 1 million times 0.665 is equal to can dollar 665,000. Step 2. Invest can dollar in Canada for 3 months. Interest rate, 3 months, is equal to 2.25%. Future value is equal to 665,000 times 1 plus 0.0225 is equal to can dollar 679,962.50. Step 3. Convert can dollar back to diem using forward rate. Forward rate, 1 diem is equal to 0.670 can dollar. Diem received is equal to 679,962.50 divided by 0. 671,014,851 diem. Step 4. Compare with diem invested in Germany. Diem interest rate, 3 months, is equal to 1.75%. Future value of 1 million diem is equal to 1 million times 1.0175 is equal to 1,017,500 diem. Step 5. Check arbitrage gain. From Canada route, 1,014,851 diem. From German investment, 1,017,500 diem. No arbitrage gain. In fact, there's a small loss. Loss is equal to 1,017,500 minus 1,014,851 equals 2,649 diem. Easy tip to remember. Buy low, earn interest, sell high with forward rate only if it gives more profit than domestic interest. Final answer. No arbitrage gain is possible here because investing in Germany gives better returns than using spot forward arbitrage in Canada. This shows how interest rate and exchange rate differences decide arbitrage opportunities. Next important long question is 7. In London a dealer quotes pound to Swiss franc spot 3.50 to 50/55. Pound to Japanese yen spot 180.80/181.30. I. What do you expect the Swiss franc to Japanese yen rate to be in Geneva? 2. Suppose that in Geneva you get a quote Swiss franc to Japanese yen spot 51.1530/51.2550. Is there an arbitrage opportunity? Given quotes, in London, pound to Swiss franc, British pound per Swiss franc, is equal to 3.5 to 50/3.5 to 55. Pound to Japanese yen, British pound per Japanese yen, is equal to 180.80/181.30. These quotes are indirect, in terms of pound, so we will calculate Swiss franc to Japanese yen cross rate. I. What is the expected Swiss franc to Japanese yen rate in Geneva? We will use the formula. Swiss franc to Japanese yen is equal to yen to pound divided by Swiss franc to pound. Why? Because yen to pound comes from pound to Japanese yen, we take the reciprocal. Swiss franc to pound comes from pound to Swiss franc, we take the reciprocal. Let's calculate the bid and ask rates for Swiss franc to Japanese yen. Bid rate, you sell CHF, by JPY. Use the lower JPY, bid, and higher CHF, ask. Bid is equal to 1181.30 divided by 1st March 50 to 55 is equal to 3.50 to 55/181.30, 0.1944. Multiply by 100 to convert to JPY per CHF. Bid Swiss franc to Japanese yen is equal to 3.50 to 55/181.30, 1944 times 100 is equal to 51.55. Ask rate, you buy CHF, sell JPY. Use the higher JPY, ask, and lower CHF, bid. Ask is equal to 3.50 to 50/180.80, 0.1949 times 100 is equal to 51.64. Expected Swiss franc to Japanese yen rate in Geneva. Bid is equal to 51.55. Ask is equal to 51.64. 2. Geneva quote. Swiss franc to Japanese yen is equal to 51.1530/51.2550. Now, compare. London expected Swiss franc to Japanese yen is equal to 51.55/51.64. Geneva Swiss franc to Japanese yen is equal to 51.1530/51.2550. Is there an arbitrage opportunity? Yes. Let's check. Step-by-step arbitrage, buy low, sell high. 1. Buy CHF in Geneva at 51.2550 Japanese yen to Swiss franc. 2. Sell CHF in London at 51.55 Japanese yen to Swiss franc. 3. Profit is equal to 51.55 to 51.2550 is equal to 0.2950 JPY per CHF. Conclusion. Yes, there is an arbitrage opportunity. You can buy CHF in Geneva, cheap. Sell CHF in London, higher price. Earn risk-free profit of 0.2950 JPY per CHF. Easy tip to remember. Buy where cheap, sell where steep, arbitrage gives profit deep.